Well, call it consolidation in the equity market. Vaughan, analysts are bullish on the prospects for U.S. bank earnings after J.P. Morgan and Citigroup reported better than expected numbers. Here in Southeast Asia, bank results are due next month, and higher credit costs and net interest margin compression continue to weigh on performance. Let's discuss all things banks with Harsh Modi, J.P. Morgan co-head of financials research, and Diksha, Gera, who covers Asian financials for Bloomberg Intelligence. Harsha, let's start with you. I mean, deal or no deal, it does look like growth in Southeast Asia is set to pick up, even though the full-blown growth not expected till 2021. That must be good news for the banks in the region.
Absolutely. See, the fact is that global emerging market growth is looking to do much better than the DM growth. And this tends to have a very significant impact on capital flows. So not only growth starts looking good, but money comes to our part of the world much quicker. And as that continues to happen, that increases the PE multiples, improves the capital market activity, hence the fee income. So you're right, it is pretty good for not only volume growth, but also PE multiples and the bank stocks broadly.
But that's pretty much broad brush, right, Diksha? I mean, you have to look at particular markets. Some of the banks in this part of the world are not looking too great.
Yeah, actually, Hasinda, I think I am in general a little more less rosy about banks, less optimistic about banks. And while I agree with Harsh's view that capital inflows are a positive catalyst, but if you just look at how different revenue pressures are arising, partly because of rising competition from the tech giants, from the fintechs. Some might argue that these are still not that big a deal, but they consistently keep chipping away at banks' ability to really make money. So that's one aspect which I think we should watch out for. And just to kind of share with you what tech can really deliver, if you look at Ant Financial, in just a year and a half, they were able to, their ability to penetrate their customer base, right? The number of customers using 3+ products with them within a year and a half grew from 30% to 80%. That tells you the threat that tech is actually posing to banks, and there are just too many pressures.
I'll pick up on technology and fintech slightly later, but I want to take a look at Indonesian banks in particular, Harsha. I mean, how upbeat can you be when you take a look at loan growth? It's what, up 6% versus 13% previously. Surely that's not where you want to be putting your money.
Not today, but with the significant reforms that Indonesia is working on, what we have started seeing is liquidity has already started flowing into that market. Portfolio flows, FDI flows, and as that happens, it improves the liquidity. And as liquidity improves, loan growth improves. Because the single largest limiting factor for Indonesian credit growth is tight liquidity. So the chain of events is now shifting, and hence Indonesian banks are a must-own today, in our view, at least for next 6 months.
But NPLs are not looking good either. 2.6, okay, lower than 3, but still higher than 2.
Yes, well, I'm actually with Harsh on this one. I think we are also quite positive on the earnings outlooks for Indonesian banks. We don't give bank recommendations, but I think the NPL problem is there. But as he pointed out, as loan growth picks up, they outgrow the NPLs to some extent. And liquidity means that there are lesser pressures on asset quality as well.
And we'll see what's also happening is they are adopting FRS 9 this year. So all the asset quality issues will be front-loaded on 1st January. They take a hit on the book, move on. So it's a pretty big clearing event.
And Harsh, you mentioned markets like Indonesia. I mean, a lot of these Southeast Asian banks last year dealt with a lot of these significant rate cuts across the board in the region. What does that mean for profitability? What does that mean for net interest margins?
So there we have to go granular. It is broadly not good news for banks which are unable to pass on the rate cuts to their borrowers, and that's why Singapore banks, we are a bit more circumspect on NIM compression. But in certain markets, let's say Philippines, we had a fantastic outcome where the cost of funds went down and they were able to hold on relatively to their asset yields, and hence margin expanded significantly. And some of that will continue in 2020. So it's a very bank-specific discussion. And I would say Philippine banks probably are best positioned on that thematic, and Singapore banks least positive on that.
And Diksha, the news that we had a couple weeks ago was this news of Bangkok Bank, this acquisition of Permata, an Indonesian bank as well. Should we expect more consolidation among the ASEAN banks in 2020? And which markets in particular attract more M&A interest, you think?
Yeah, hi, Yvonne. I think M&A definitely could be one of the themes that we could see intensify going forward, besides the whole tech adoption conjecture or the conversations that we are having. I think you would have followed Kasikorn Bank looking at another Myanmar bank as well. So obviously there's more interest in growth and more from the Thai banks coming along, which kind of speaks to how desperate the situation is in terms of the local growth dynamic and also just the scramble that the banks are facing for scale.
And in terms of digital licenses, Singapore's about to issue 5. What's your take and what impact would it have on traditional banks?
So the interest is huge, 21 bidders for 5 licenses. So there are 2 bits of it. On the retail license, we have time. It'll take 2 years. For first 2 years, there is a cap of 50 million total balance sheet size. So it'll be a while before which we can see the real disruptive power of the banks. And to their credit, the Sing banks have done a solid job in last 5 years to kind of preempt some of these changes. Pay Now is here. It's much easier to compared to, let's say, India, where UPI just took everybody by surprise and disintermediated, which is not the case in Singapore. So I am not very worried on that. Yes, it'll start chipping away at some of the fees, let's say, transaction-related, remittance-related, and so on and so forth. But it's not a game changer per se. To me, a much bigger impact would be on the wholesale banking. Because that is a full-fledged banking license, and we had many different kind of players coming in. That becomes way more competitive. Retail banking in Singapore, I think we will have enough time to form opinion on that.
Of course, we have to take a look at regulation, Diksha. I mean, we've had central bank governors like MES, for instance, saying pretty much like, if you look like a bank, you act like a bank, you'll be regulated like a bank.
Aslinda, we are massively undermining tech companies' ability to not look like a bank and still hurt a bank. So if you just look at Google offering Google Pay, our sense is that this is just the start. There is more coming, the verdict is quite out there. But what I really want to point out is that this disruption or this change, what it will actually do to the mainstream banking sector is that it will start showing divergence between the tech advanced and the tech laggards. That is the one big change that this will bring about. Because if you look at the tech side of the mainstream banks, that's still a black box. We have very weak disclosures. We have no visibility in terms of what banks are doing what. Now that will start showing in the bank's ability to really generate business and differentiate themselves.
As much as we say that traditional banks are with it when it comes to fintech and they have deep pockets to buy fintech companies, it's still in its infancy, right? When you use chat bots, for instance, Harsh, I get really frustrated.
See, the way to think about it is, think of ATMs decades ago. Does it change banking? Not really. Banks still do take cheap deposits, lend long. They do credit underwriting. These are the 2 main things they do: manage liquidity, manage credit. How they do it changes. So that is what we are going to see in next 12, 18, 24 months. And I think Sing banks have led from the front. They have basically transformed their own selves. And regulation is the biggest moat around banks, because ultimately depositors needs to be protected. That liquidity, that capital will ensure that, yes, even if tech companies become big, they become a bank. Then the question is, once you start getting regulated like a bank, you have the cost structures of a bank, can you still be profitable? So yes, I understand where you're coming from, but I would be less worried on banks getting disintermediated rather quickly.
Survival of the fittest, very quickly. In Singapore, all the 3 banks will survive?
Well, I think they should. I think MES's stance has been very proactive. And as Harsh also mentioned, they've literally taken this problem head on. The regulations also make sure that there's no predatory pricing. So it looks like we want more competition, don't we?
We always do. Yeah, well, consumers are supposed to benefit. Harsh Modi of JP Morgan and Diksha Gera from Bloomberg Intelligence. Well, still to come, Boeing loses its title of the world's top